Now let's get more on Meta's third quarter. The stock trading near 2016 levels in the after hours on news that the social media giant sees more weakness in the fourth quarter. Let's bring in Scott Kessler of Third Bridge, where he covers big tech. Scott, how do you think the stock is looking, trading at a forward PE now of just above 12?
Yeah, thanks a lot, Melissa. I don't think people are overly concerned right now about valuation. I think they see a company with 2 straight quarters of revenue declines. OPEX and CAPEX have continued to increase significantly, and now the company's talking about essentially a hiring freeze and a facilities realignment. These are things that are not giving people positive signs as we look to close the year and start 2023.
I guess embedded in my question, Scott, is there a PE at which this thing is so cheap that you can even overlook the things that you outlined, or is no PE appropriate for a company in this position at this point?
Right. So we focus on the fundamentals of sectors, industries, and companies. And right now, it's pretty clear that Meta has a lot of challenges. What's interesting is they've known about some of these issues for a while at this point. And experts that we talk to suggest that the company could have gotten ahead of what happened in terms of IDFA a little bit better than they did. They could have come up with some workarounds. And then in addition to that, of course, the weak economy has not helped at all. And so they are really in a tough spot, and they haven't been in a challenged economic situation like this as a public company in a way that I think people gives them any level of kind of confidence.
Hey, it's Karen. Thanks for being on. So if you were they and you hear this sort of, onslaught of the spend is just way too much, what would you do if you were they? And if they did cut the spend by a lot, does that change your view of the story? I mean, everyone's in an advertising slowdown. That's not particular to them.
Yeah, no, I think that's fair, Karen. So a couple things, right? And I think, some people have been public about this. They've been talking for the last year about the metaverse and the promise of the metaverse and the billion users in the metaverse over the next decade. That's not going to happen for a while. And so I think they need to be more realistic and frankly more conservative when it comes to the spending that they're going to do as it applies to the metaverse. That's number one. Then number two, they added thousands of employees just in Q3 alone. I know they indicated that they won't be adding on a net basis any more employees through the end of next year, but I don't know if that's good enough. I think they probably need to make some harder choices related to the employee count. And they also need to kind of indicate to us how they're going to refocus the company and reignite growth.
So in terms of reigniting growth, Scott, and sort of pivoting away from the moonshot of the metaverse and back into their core business, what would you recommend? Do they reallocate that spend to Reels? What are the things that they can do? Is there low-hanging fruit that they can do to sort of revive the story?
Yeah, so a couple of things, Melissa. I think based on conversations that we have with experts on a day-to-day basis, there are two things that come to mind. Short-form video is definitely at the top of the list. That is the single biggest priority, it seems, over the near term for the company. And it's our sense that, they need to get to 50 or 60% of users' time spent on Instagram with Reels to really start making an impact with that particular platform and service offering. They're not close to that yet. I think they need to essentially double where they are now. Secondarily is e-commerce. It seems like they made a big splash when it came to e-commerce 2+ years ago during the height of COVID. Now they've pulled back. It seems like TikTok is really cooking their goose when it comes to both short-form video and e-commerce, where it looks like Meta is pulling back, and you look at TikTok and they're moving full steam ahead. So those are two opportunities that are right in front of them, and they just need to focus and execute. Our sense is that their advantage over TikTok, and they're 2 to 3 years behind when it comes to the algorithm and all of that, but they are ahead when it comes to monetization. I think they should focus on that and really invest aggressively.
All right, Scott, great to get your take on this. Thanks a lot, Scott Kessler. So a couple of opportunities right in front of them, but these are still I don't want to say long term, medium term. They're not immediate things that can be accomplished, Bonawyn. How are you feeling about the stock at this point, which is, by the way, after our session lows down almost 17%?
I mean, I think you bring up some good points. I mean, they're more investment, but they're medium-term investments. And we've talked about the rate environment and how when you're discounting something that's happening even 5 years out into the future in this current rate environment, you're going to have to take a discount. So now we're talking about something that's twice as long in terms of maturity, and they're continuing to pour money in. So like for someone who's constantly looking at DCF models, I don't even know what IRR to kind of attach to whatever this metaverse thing is. And I think that's ultimately what's giving investors angst.
So, Bonawyn, is there some level at which you would say, all right, there's a giant business there. Clearly, they've lost their way, or the street really believes they've lost their way. Is there some point where you would say, all right, the risk-reward is compelling?
Sure. It's just that I would have to massively discount the upside that I expect, because to the point earlier when we were discussing, if they were to pivot, I agree with you wholeheartedly that it clearly abates the cash spin. But to me, that's them throwing in the towel on them being a growth business. And if that goes away, well, then now I'm saying, OK, now this is just a value play. And I expect that growth to be much smaller and stable over time. But the opportunity cost for me putting money there is again, much higher. So it's just that my upside just gets discounted so aggressively. Sure, I think it becomes a safer play, but one that's with much less robust upside.
Guy, I've got a question for you.
I like this game.
17. Who said it was a game? Down 17% right now. Does this stock look better or worse than it did at the close? Better because the valuation is
infinitely
lower? Okay.
No, it's worse. I mean, it's a disaster. I mean, we've been saying this for a while. I mean, here you go. A number of people on Twitter pointed this out, and we started the show with this. They bought back $42 billion of stock over the last year at an average price of $300. So they're lousy traders, number one. I mean, that just goes without saying. They're betting the future of the company on something that nobody understands and they can't explain, number two. And there's a certain arrogance to that, number three. At a certain point, all they have to start doing is basically monetizing a user base that is head and shoulders above everybody else's. But if I'm Mr. Zuckerberg, which I'm not, I'm getting on the blower to the White House and say, hey, you got to do me a solid and ban TikTok, because to me at this point, that's their lifeline.
That would be a game changer potentially for Meta if that happened.